So our total return on investment going to be 15%. So what is the benefit of two-step ROI? So it helps us to find out who did well, whether our asset efficiency is very good, right? And if you want to compare with previous year ROI or this year ROI, then you want to see that whether we generated enough sales to make margin or not, or whether we improve our turnover ratio, that's why our return is higher or not. So that question please remain in your mind. Must be, you should keep in your mind that sometimes decentralization act as a barrier in innovation, right? So if a manager is evaluated on the basis of ROI, then he must think about to improve both of these ratio, turnover ratio and margin. So what do you think? What happen if manager invest 30,000 piece of equipment that increase sale by 35,000 while increasing operating expenses 15,000? So what happened here? A manager purchased 30,000 worth of operating asset, which increases the sales 35,000 and increasing the operating expense 15,000. So what will be our new income gonna be? 50,000, right? So previously, what was our income? 30,000, right? Our question says we have income of 30,000, but now our income has increased to 35,000, right? And our assets have now increased from 200,000 to 230,000. Our sales has increased by adding 35,000, which is 535,000, right? So if we calculate now the ROI is, the margin is 9.35%. Why? Because now income divided by sales, right? And look at that. The turnover is sales over average total assets have now increased. So it's 2.33. Now, we know that ROI is increased considerably, 15% to 21.8%. But if the manager is evaluated, the cost center manager, who is to control the costs, right? So he's evaluated based on turnover. So look at that. In previous, the turnover was 2.5, and now the turnover is 2.33. Look at the overall benefit of the organization. Overall, company's profit is increased. Margin ratio has increased from 6 to 9.35%, right? And ROI increased from 15% to 21.8%. But the manager who is evaluated on the basis of turnover, the cost center manager, he will say, I don't want this. Why? Because my efficiency is now going down. I am evaluated based on efficiency of the assets, turnover. But due to this investment in new asset, my turnover is going to be decreases and I'm not going to be given bonuses. So he will make ways that company will not acquire these assets, right? So that's why those associated disadvantages that they don't see the bigger picture, right? They just want to talk about their own fame, their own bonuses, their own self-interest, that's it. So this is the biggest reason, right? So the question is, if you base ROI, because our chapter is performance evaluation, performances. If you want to check performance, whether this manager did good or bad, so this is the biggest drawback. So do we need to change to a new different method? Because most of the traditional organizations, they are basing ROI in their performance evaluation, right? So the biggest criticism is that in the absence of a balanced scorecard, management may not know how to increase the ROI. Managers often inherit many committed costs, however, they don't have any control. So in this case, if this scenario is initiated by the head office, then managers have no control over its own performance. And he would say that, look, if it's up to me, I would never ever purchase this extra 30,000 of assets because my performance is going down. It is coming from the head office. So I have no control over this, that my performance is down. It is because of the head office who has purchased the asset, and that cost me my bonus. Managers evaluated on ROI may reject profitable opportunities as well. So look at our previous example. So that was a profitable opportunity. If they have given to you, they will always reject that, because I'm not going to be evaluated on ROI basis, because in that case, my performance is going to be go down, right? So then there is another method. We call this residual or residual income method. So let's talk about its strengths and weaknesses here. So this is the another measure of the performance. So its criteria is, if you are able to earn more than the minimum required rate, then you will be given bonus. That makes sense, right? Rather just evaluating based on ratios, and ratios depend on numerator and denominator, right? So ratio is, you cannot control that ratio. If denominator is increase or numerator is increase or decrease, or both increase or decrease, it has consequences, and you don't know about that. And sometimes the evaluation performance is out of your hands, right? So why not we create an idea in which we give you some minimum target, and you achieve that target. If you achieve to able to earn that minimum operating income, on the top of that, we will be giving you bonuses. That makes sense? We call this residual income performance measure. So what is the formula? Formula is whatever have you earned minus what is the requirement to earn. So net income that you earn minus average operating asset multiplied by the minimum required rate of return. So this computation, of course, different from the ROI method. So ROI measures net operating income earned relative to the investment in average total assets. But residual income measures net operating income earned less the minimum required rate of return on average assets. So if the head office has given to you that, okay, you are required to earn 15% on average assets. So if your net income is 16%, then you did well. It means because we required from you 14% or 15%, you earn 2% more. So you are eligible for promotion or bonuses or whatsoever, or performance evaluation is like that, right? So a concept checker, which method is good? Sipade. David?
Sir, I can't see the concept checker.
No, that's I'm speaking here.
Oh.
Which method is good?
What are the options, sir?
ROI method and residual income method. We just talk about two methods, David. Arone, Christine, Chandra. Min, what do you think? Which method is good? You get my point or not? Whether ROI method is good or whether residual income is good.
ROI.
ROI is good. Okay, Sipaday.
Mm, I'm not sure.
Not sure. Okay, Chandra.
Oh, I'm not sure as well.
Min,
I'm not sure as well, sir.
Arone.
I'm not sure too.
Okay, we just talk about that. That ROI has a problem with the evaluation of the manager, right? And to eliminate that problem, we introduce residual income method, right? So of course, the residual income method is better than the ROI, in which nothing hidden is there. You are just given the rate on the average assets. And if you beat that one, you will be given the bonus. That's it. Simple. Rather than difficult complications and the ratio concept, numerator over denominator, and you have no control over that, right? I just told you that the ROI method is have some kind of strong criticism on that because managers sometimes reject profitable opportunities. Okay, let's just talk about the example here. So the retail division of Zephyr Incorporation has average operating assets 100,000 and they are required to earn 20%. In their current period, they earn 30,000. So what is the residual income? They were given target 20% on the assets. So 20% of the assets are 20,000, but they earn 30,000. So what is the residual income? 10,000. Right? The name looks scary, but the concept is quite simple. Right? Actual income minus the minimum required income. So it means they exceeded their requirement. Right? So residual income encourages managers to make profitable investments that would be rejected by the manager using ROI. In ROI, when your income increases to 30,000, we saw that return on assets decreases, the turnover decreases, and managers who are evaluated based on turnover, they would reject that opportunity. But here in the residual income approach, we will select that alternative. Why? Because it is giving us a positive residual income. So we have a new concept checker. So please, all of you guys calculate that. So Raymond earnings are division of